Hello, everyone. This is Russ Conti with Club Benchmarking. It's a couple minutes after 2, so I think we're going to get started. I appreciate everybody joining today. We've got a good group, and it's great. I see a lot of the same names coming into these webinars, so it's great to see the same folks coming in. It makes me feel like the folks that are coming in see value in these if they keep coming back. So I really appreciate that, and I hope that everybody gets something out of today as well. Just a little housekeeping. Today the material is a little bit shorter than normal, so I usually end up running about 40 minutes. I think we'll be closer to the 30 minutes today, but we'll see how it goes. And the other piece is if you want to submit any questions for us to answer during the webinar, you should have a little chat box in your GoToMeeting control window. It should appear somewhere on your screen. So if you have anything you want to ask, we'll hopefully try to get to them during the session. If not, we'll try to hang on to anything we see in the chat screen, and we can get back to you after the session if we don't cover it inside. So today's session is really the fifth in the session that we've been doing around the notion of the executive dashboard and the executive dashboard key performance indicators. We're going to go into that a little bit as a little bit of a preamble, and then we'll do a little bit of a wrap up. But today we're specifically going to talk about the KPIs that are related to debt. Clubs taking on debt and how to measure that debt sort of relatively, not just as an absolute number. As you know, a lot of what we look at, we don't just look at as a hard absolute number, but we look at as a ratio so that we're able to put it in context and have a little bit more meaning, within the club. The whole notion of the executive dashboard really came to be, frankly, we appreciate the feedback from our users, because it really came to be from our users, asking us, hey, there's a ton of, great data in club benchmarking, but help me understand, what's really important. What really are the top things that I need to make sure my board is thinking about, or I'm thinking about, or the finance committee is thinking about. And so that's something we heard over the last couple of years, and it was, I guess, around back in April or so, we really looked at a lot of the indicators we were looking at and tried to do a lot of correlations and step back and say, okay, if we really were to boil it down to those 10 or 15 things that really are a very strategic snapshot of the financial aspects of the club, and those items correlate to financial sustainability of the club, what would those items be? And so that's really was the genesis of that. Now, since we've actually added to the notion of not only does that let an individual club see what's important to them, but in this world of the executive dashboard, we really started thinking a little bit larger and said, well, wait a minute, what if every club in the industry literally used those same indicators to sort of measure and understand themselves and to explain their financial model to the board or to the finance committee or to the owners or whoever it might be. Being able to, understand and explain the financial model of the club, is critical, and it really is important to the discussions that you have in the club. So that's kind of the notion of the executive dashboard, and sort of how it came to be, and sort of where we're going with it now. We really see tremendous opportunity in having this common view that all clubs measure, just like many industries have a common set of measurements that they use. And so we think there's a huge opportunity so that when you've got board transitions, or a GM or a controller moves from one club to another, you don't have to reinvent the language, right? Because you have a new president came in that wants to measure a whole different set of things, or you move to a different club and they measure everything differently than you measured in the old club, right? Imagine if that was a consistent set of measures at the strategic level. It's there's a great opportunity there, and huge value to be mined, I think. This is just one of the series. We've obviously done executive dashboard webinars, but we've been doing these fast fact webinars for probably a little over a year. We've got probably 12 to 15 of them archived. They're very, topical, very concise generally. And, for folks that haven't gone into that page and taking a look at what else is in there, we do always archive these webinars, and I suggest you go in and take a look and see what might be of interest. We just did one last month on budgeting, strategic budgeting, using benchmark, and that was one of the highest attended webinars we've done so far. Obviously, it was important for that time of year. So go in and take a look, because there's a lot of great information in there. You don't have to be a member. That's all free, right? That's stuff. That's part of what we do for the industry, is we try to convey convey, everything we learn to everybody. Obviously, some folks use the platform and some don't, but it's great information in there to take a look. So today, really, our goals are pretty simple. We're going to review the only two debt-related KPIs. We'll look at some other numbers around it, but mainly two debt-related KPIs that exist on the executive dashboard. We'll dive into them, but one of them is a debt-to-revenue ratio, and one of them is a debt per full member equivalent. And we'll take a look at those and explain kind of what they are and why we think they're important. We'll discuss the implications of them. And we're going to talk a little bit about debt in general and ways maybe clubs should think about debt. But the whole goal behind everything we do in club benchmarking or with the executive dashboard is to really inspire proactive thinking rather than reactive. Instead of answering board questions and just responding to the sort of the political topic of the day, it's really getting ahead of that curve, and by presenting in a very professional manner. Here are the things that are important to clubs. Here are the things that the industry measures. Here's where we are, right? Maybe it's where we want to be, or maybe we want to shift it a little bit, but at least we know where we are. And so all that is around the notion of standardized measures, and is really at the very basis of what we do. And having those standardized measures, while we've traditionally always used the past data and understanding, how did the club do, right? How did the industry do? Well, once you've got a few years now under our belt of looking at those indicators and users understanding those indicators, you can start to use those looking forward and use them in a predictive manner, not just a reflective manner. And as some of we recently opened up a financial forecasting section of the tool for users, and that's all about applying all these measures we talk about to the forward-looking view, right? The budget and forecast view, not just to the rearward-looking view. So that's kind of where we're going for all this. But we're going to focus specifically on just the last two we have today. I'm just going to take a few minutes on that. Most people know that have been on these before that I do take a minute or two just to go through some interesting aspects of the industry. It's a $20 billion industry. Pretty good sized industry, not huge in as far as some other industries go, but it's a good sized industry. What's unique about it though is it's extremely fractured, right? There are, depending on what you count, there are 4,000 to 5,000. This is actually the CMA world we're looking at. So we'll say there's about 3,000 clubs in that $20 billion industry, and the median club being about a $6.5, $7 million club, and there is there is a large player, about a $100 million club. But the point is, it's very flat. Most industries, if they were 20 billion, you'd have a $2 billion player and a few $1 billion players. And this is a very flat industry, which is one of the reasons I think that there has not been much standardization in the industry. Is there's 3 or 4 or 5,000 little fiefdoms out there, and there has not been, a coalescing standardization body. There has been on the accounting side, right, USFRC, but I don't think there has been on the business management or business intelligence side, or what I would really call financial management. And I think it's been a place that's needed some effort. Every club's got about 11 board members. So you've got, in those 3,000 CMA clubs, 33,000 board members, people walking around the country saying, hey, I'm on the board of my club. I help govern my club. That's a very daunting number. We know that they are not highly in tune with the way the industry actually works and with the financial machinations of the club. And to make it more challenging, every year a third of those turn over. So it's really a challenging environment. It creates a lot of ineffective governance. And so, one of the things that we think is an opportunity is standardization, so that when you get a third of that board turning over, there's a standardized set of measures in place for them all to come into and understand. I don't think we need to go through this. We've all seen this chart before. I present this a lot, but it's basically the notion that there's a lot of misperception around the things that are really important to the club and the discussions that are had in the club and in the boardroom specifically, and that there's too much imprinting of other people's industry business models onto the club industry because they've come onto the board, right? That happens a lot, and it's to the detriment of the industry. It's not helpful. It's hurtful to the industry. So we all know that exists, and it's part of what we're all trying to fix. I'm going to blow through this. We all get it. There's lots of different functions in the boardroom. This happens to be Ray's club, Ray Cronin, and most of you probably know Ray. And, it's a very diverse set of people from all different backgrounds. So we always say, what are the chances that those will have an innate common view of governance or an innate common understanding of the financial model of a club? Or even how we're talking about today, even in respect to debt levels, right? You have some people who say debt is bad. Some people who say, hey, interest rates are low. We should get as much as we can. Some people in the middle. So, unless that's some collective set of measures for them to start the discussion from, all you do is have those cultural or ideological beliefs to start from, and you're not starting from a place of fact. You're starting from a place of emotion and opinion. But it's about changing the dialogue. That's kind of what this is all about. We won't spend too much time on that. So if we go into, this common language, the notion of common language, we've got queued up a couple common language items around debt. This you've seen before. This is just the notion that, all industries have common measures they use. The club industry has been a little bit unique in that. And I apologize, I'm going quickly through this because, I recognize most of you have seen these before, so I don't want to take too much time on this aspect. I'd rather spend time on the actual data points themselves. But, the whole notion is this is about applying a common language. In the world of the executive dashboard, we're down here to these last two, as I mentioned, and anyone that's a member who's run their executive dashboard report probably recognizes this table because it comes right out of that report. But obviously your data would show up in this left-hand column. But those are the two that we're going to look at today. They are the last of the 5 sections. And the 2 questions, whenever we look at key performance indicators on the executive dashboard, we tested ourselves and we said, you know what, we need to make sure that, do we answer an important business question with the indicator? And the 2 we're looking at today, we think they answer 2 very important questions. The one, debt per full member equivalent, frankly, it says, what's the burden of debt down to the membership level, down to the individual member, so that it's a way to measure what's the economic horsepower of our membership, and is our debt level congruent with that economic horsepower, right? If you've got a very sort of pedestrian, not to be demeaning, but a pedestrian club with not a lot of, really, what I'm talking about, the high power versus the low power type of membership. If you've got a more of a pedestrian level club and you've got an FME, of $25,000 of debt per FME, that's going to be a big problem. If you've got, the kings and queens of industry and of wealth that tend to make up your membership, and you've got $25,000 of debt per FME, that might be a different story. So there's a tie-in there to that question, to the actual membership. And then the next one, how leveraged is the club? And that's the debt to operating revenue ratio. It's a pretty important number. In fact, we talk to a lot of folks in the management company world who do treat clubs more as a business, and they use that one quite a bit to understand, frankly, how salvageable is a club that's gotten themselves into very, very bad debt problems. How salvageable are they? And we'll talk about that specifically in a minute. Actually, right now. So when we look at the debt to revenue ratio, it's very simple. It's obviously an extremely simple equation. It's the total debt principal level divided by the operating revenue of the club. Most of you might be able to do that sitting where you are now, just off the top of your head. Those are 2 pretty basic numbers in the club. Obviously, it gives you a specific measure of leverage, and it tells you more. I use this analogy with food and beverage sometimes, but $5 million of debt to one club may be off the charts, out of control and not sustainable. $5 million of debt to another club is very manageable and might even be considered very, very low debt level for that club. And the way we do that is by measuring the debt to operating revenue, because it sizes it. Operating revenue is a great sizing mechanism to use. Helps you understand, are you using debt as a tool or is it really a burden? And frankly, it can also be a reflection of the club culture or the board culture, perhaps even. But, there are some clubs that just frankly have a culture of, we don't take debt, right? Doesn't matter what the interest rates, what we want to do. They tend to be, frankly, the clubs that have very, ironically, a very high economic horsepower of their membership. right? So they're just going to say, hey, we're going to go assess our members $10,000 each to build whatever it is we want to build. We're not going to go out and take debt because that's the culture of the club, right? We self-fund, in effect, right? We self-fund the club. Other clubs obviously aren't in that situation and are more amenable to taking on debt. When we look at the actual numbers, so now in the industry, what is a typical, or what are, we don't give our opinion. We just say, what does the industry actually do? So in the industry, when you look at debt to revenue, the median of the industry runs at about 41%. So what does that mean? That means if you were a club with $10 million of operating revenue, and you were right at the middle of the industry, you would have about $4.1 million of debt on your books. Obviously, there's a very wide variation among that. It doesn't say that a club should be at 41%. It just says that where the industry is. And generally, if you look at these very low debt levels and below, generally about 20, you could creep up to maybe 25% almost of the industry, fundamentally has basically no or extremely low debt. And then you've got about 25% of the industry which has pretty significant levels of debt. You start getting at 75%, certainly at 100%. So if you're a $10 million club, that means you have $10 million of debt. That to me is sort of a little bit of a red flag, yellow flag zone. And I think that when certainly a club is thinking of taking on debt, understanding where you are in that curve, and this is the one that answers, how leveraged is the club? I think this is one where I like the term, if you stay between the fences. I think if you stay between the fences, or certainly if you have a culture of no debt and you don't need it, that's fine too. But getting up into this upper quartile in this particular indicator, I would say is a yellow flag. And for the clubs that are up in this 150 percentile range, that's really a red flag. And there are clubs that are up there. The notion we use, and we've talked about this with a number of folks in the industry, we've seen it with a lot of club results, that you're really entering the danger zone up here, and if a club gets to above 200%, it's really in the danger zone. You're probably in a zone where, if there's not a really focused strategic intent of getting that debt to revenue ratio down, it may be the undoing of the club. I was talking with a GM. It had to be 3 or 4 months ago now. I think they had just joined or were just thinking about joining, and we uploaded their numbers and ran everything, and they had a debt ratio of 246%. It was the highest I've seen. And I asked them, I said to I asked the GM, how often does the board talk about debt? And he said, never. They never talk about debt. And what do they talk about? Well, they talk about food and beverage, right? Not a surprise. But that's an indication where they're probably heading over a cliff because of debt, and they don't even know it because, they didn't even think to look there. I don't know how they would know it, because the interest payments, frankly, I would think would be, stealing all the cash of the club. But nevertheless, that's the industry. So then, interestingly, now we've been doing this for 5 years, coming on to 6 years. So I ran a chart. This is the multi-year report. If anybody who's a member wants to look at some of these multi-year reports, it's very interesting to see what's happened over the industry over the last 5 or 6 years, through the downturn, then trying to coming out of that a little bit. Interestingly, debt levels were about 41% of revenue, about in that 2009 zone. Debt ratios went down, through the downturn. Clubs, I think, were pretty averse to taking on debt in those periods. But interestingly, we're back up at around that 41% now. Now we're just starting to collect 2015 data. So, we've got because obviously so far we've only collected pretty much September and October fiscal end clubs, and we're still rolling them in. We've probably, got 50, 75 clubs in there now. But, of those clubs, that ratio is high. Now, there's no way that 59% is going to hold. But I wouldn't be surprised if we see the debt ratio to be up in the 45% range. I think there probably is. I've just seen it, right? Everybody knows clubs are doing pretty significant projects now. They're out there, they've taken on debt, and there was sort of a lot of deferred project work, if you will, that I think was happening. And now that things have gotten a little bit more stable, I think clubs are taking on debt and are doing some of those large capital projects. And so I think that we're going to see that. but we're going to need another few months of gathering data. It's not going to be up here. It'll be down lower. But I think we're going to see that trend of increasing debt and increasing leverage really would be the right way to say it, since this is a relative number. But it's interesting to see that, and it's a trend in the industry we're going to keep an eye on. So that's the one key performance indicator, and I think understanding where you are, just to go back to this chart, is obviously critical and an important thing for the board and management to understand. Next, we look at debt per full member equivalent. Very simply, it's that debt principal level divided by the FME count. And as most of you know, full member equivalent is your total dues revenue divided by what a full member pays. And that way we normalize between socials and all these other different categories. And it's one way to normalize across the industry. Basically, the membership density of a club is by using full member equivalents. We do a lot of ratios that are something as a percentage of or something per full member equivalents. Again, it's irrational for the economic horsepower of the membership. That's the way to think about it, right? Are we a club that has members that really are at a place that can afford the level of debt per FME that we've got or that we're thinking about taking? And again, I do think this is also a reflection of the club or board culture. If we look at this KPI from the executive dashboard, by the way, anyone that runs their executive dashboard, there's two versions of it, right? There's the Word version, which gives you the table of KPIs all in one page. It really is a snapshot, and then you can run the PowerPoint version, which gives you the view of each metric on a curve of all the other clubs you happen to be looking at in your distribution. So what we see here is that debt per full member equivalent is about $5,800 at the median. And again, we see down here, same kind of story, right? This lower quartile, fundamentally, zero debt to very low debt per full member equivalent. And we see in this upper quartile, getting into some pretty lofty levels, $10, $15, $20,000 of debt per full member equivalent. And this is bank principal debt, right? So it's loan debt. Or I should put it this way: it's any long-term debt that you've got on your books. So I just see a question come through: does it include the liability to members' equity? And if it's if that liability is on your books as debt, as long-term debt, then yes, it would. We would code that, I believe. That's something I'm not 100% sure of, and I like to always make that distinction. I'd want to talk to Jim Boyle on our team, who's in charge of doing all of our data mapping, to see whether he codes that in as not. So actually, let's hold that. I don't hold me to that, but it's a good question. It's an excellent question. I just don't know the answer to it. Maybe Terry, if you're on, maybe you could actually ping Jim and ask him how he codes that, and then when we come back at the end, maybe we'll have an answer for that. So let's try to do that in real time. And again, clubs that are up here in this 25,000 of debt, we chop off the last 5% because those tend to be outliers. But there are clubs that have $25,000 of debt per FME, and you better have some pretty high power members if you're going to have a membership that supports that kind of debt load. By the way, obviously your debt per full member equivalent can be impacted by how much debt you have, but it's also impacted by the number of members you have. So if you're a club that takes on significant amount of debt, and then for whatever reasons you start losing members, obviously the debt per FME is going to go up. Likewise, if you've got a level of debt and you're adding members, your debt per FME is going to go down. So these are dynamic benchmarks, and you can obviously move the numerator or the denominator. So then I did take a look also. I believe I ran a chart. Yeah, the 5-year view of this as well. Interestingly, it's sort of up and down. I mean, you see a little bit of a. I think what you see is it is what it is. But a little bit of a debt per FME lower coming into out of 09 into 10. I think you probably saw a little bit of it. There's two moving parts. There's no doubt about it, right? In 10, 11, and 12. There are two moving parts happening at the same time, clearly, right? Because that's the downturn of the industry was coming through that. So clearly you had clubs that really were, losing members. You had those marginal members which were leaving, everybody who's been in the industry through that period understood they had that, both large and small clubs. Memberships were waning, and the heyday of the wait lists of 2006, 7, 2005, immediately went away into 2000 and 9, 10, 11. So I think you had both FME count going down, and you probably had debt levels not going up. You probably had debt levels staying equal, and as a result, debt per FME looking to go up. But nevertheless, what we are seeing into coming out of 12, into 13, into 14, clearly on a per FME basis, debt levels increasing a little bit. And again, this can be both. I think in this case, it's probably because of debt increasing as opposed to FME decreasing, right? Generally here, memberships were coming back nicely and have come back for the most part fairly nicely. So these are happening even with, I think, in general in the industry, increasing membership. So I think it is reflective of more debt being taken on. Now, again, it's too early to tell. I don't really expect 2015 to reflect an $8,000 of debt per FME. I think it will be higher than 14. I think we'll follow this trend, and we'll see over the next couple months. We'll see where that comes out. But again, a good indicator if a club's thinking about taking on debt to understand. Other measures that are important to think about relative to debt is people think of it a lot of times as just a balance sheet item, but quite often it's an income statement item too, if you will, or an operational item, because the interest on debt typically is funded by operations. Sometimes an assessment also covers interest, but quite often we see the interest payment is coming from operations. So in effect, that's in competition. That's a tax on all the other things that your gross profit has to fund. Now, at the middle of the industry, we see that it's a pretty low amount. It's about 2% of a club's gross profit goes to pay interest on debt. And not surprisingly, if you get up into this 8, 10, 12% range, that's a pretty high burden. What you see for clubs when you look at how they allocate their gross profit, which as we know is a really important way to think about themselves. This orange slice is where debt sits. It sits with two other items. The way USFRC bundles things, it's your property tax, liability insurance, and interest on debt. So we can see, here's a typical debt club. That slice, cumulatively is about 9%. In a high debt club, that slice can be as high as 20 or 25% even we've seen. So it starts to put in pictures, hey, wait a minute, we've got so much interest payment going on that it's squeezing out the other functions that we have to fund. Now, if you're taking on an assessment to do that, to pay that interest, it's okay because in effect, the effect of that assessment is an increase in gross profit. So you're funding it that way. But if you're not, if you're only doing no assessment, or if you're doing maybe an assessment only to cover the principals, you're burdening your operation. So when you think about taking on debt, think about it from a perspective of where is that interest payment coming from and what competition does that create amongst the other things that I need to fund with my gross profit. I hope that makes sense. It's not one of the, it's outside of the quote unquote KPIs in the executive dashboard, but, we're talking about debt holistically here. So I think that's an important perspective. Just as a number, it doesn't mean a lot, but the median of the industry for a club is about $2.5 million of debt. And again, you've got this upper quartile where, you've got clubs that can go much higher. Again, we chop off the top 5%, but, there are clubs out there that, have 30, 40, 50 million in debt. Those are the very large clubs, obviously, and generally have the horsepower to take care of that. But, I think the reason I'm showing this chart is because I think this conveys the notion, after we've looked at the KPIs we looked at, debt as a percentage of operating revenue and debt per FME, it kind of makes you feel that, well, if you're just thinking about debt as an absolute number, it doesn't really tell you anything, right? I don't know, is 2.5 for my club, is 2.5 million high, low, typical? I don't know. But if you start to look at it as a percentage of revenue and as a percentage of, or as a per FME, it's got a completely different meaning, and it's got a relevant meaning. So I put this here to just say, don't think about it just as a dollar number, because now I think, hopefully after the discussion we've had, you can see where a dollar number by itself really doesn't have a whole lot of meaning. Um, and then, it was interesting. We had a club a couple months ago ask us, hey, in your balance sheet and capital report, I want to run a chart that shows, the cash level of the club minus the debt principal. I don't know that it's highly indicative of something, but I think it's interesting. So we did that. We just ran a chart, and I decided to put it in here too, just to give a view of, cash relative to debt. And so what it shows is, interestingly, the break even, the zero line, is right about, I'd say, the 2/3 mark. So basically what it says is, when you factor in debt versus cash, about a third of clubs have more cash than they have debt. By the way, I'm going to go, not intuitively, those are very likely the clubs that we saw down on the lower quartile before, that frankly have fundamentally no or very low debt. So that's not a rocket science there. But it is interesting that about 2/3 of clubs have debt levels that are higher than their cash levels. Again, it's just an interesting point. In my own mind, I haven't yet reconciled what I do with this information yet, but it was just interesting. And this I think is interesting down here, that you've got, some clubs with pretty high debt levels relative to their cash levels. And again, a club doesn't need to hold on. If you've got 8 million in debt, doesn't mean you should hold on to 8 million in cash, right? I certainly wouldn't say that's a requirement. But if you've got 8 million in debt and you've got 500,000 in cash, that might be an interesting debt to equity type of situation to look at. And it's a case where I'd say, really understanding the ability of your membership to fund that level of debt, and how is the interest being funded, and all those kind of things. It's just a dot to think about. So in a little bit of summary, when we start to look at debt, those are the two KPIs we look at. Clearly, debt's a valuable tool. There's no doubt about that. Most clubs, as we see, have some level of debt. Now, the key is obviously, hopefully, those clubs are using that debt. Hopefully, you're using debt as a way to enhance the value proposition of the club. I think of, debt is it's capital, but it's different than the capital you collect, in my mind, through initiation fees or capital dues, right? In my mind, that kind of capital is what I call maintenance capital. It's to fund replacement of the current assets of the club, right? The current fixed assets of the club. Debt, hopefully you're not taking out on debt, to pay for a new mower, or to redo, carpets and drapes, and what I would call more basic maintenance of your assets. And debt really is used to build something new and special that enhances the value proposition of the club. And so that when you tell people who that are thinking of joining, oh yeah, we're doing this, we're building this, we're going to build an outside dining area here, we're redoing the pool deck, whatever it is, we're putting in tennis courts, it's a value proposition adder to the club. In my view, that's the right way to use debt, as opposed to capital income, which is more of a maintenance kind of thing. Obviously, how do we pay it back, and what kind of burden does it create? Frankly, the financing discussion, I'm not going to get into that. That's a whole topic in and of itself, but, that's obviously a significant part of that decision. How is the interest serviced? Obviously, you can service it through assessment, or you can service through normal operations. As we just talked about, if you service it through normal operations, that debt service is a tax on the other things that your gross profit has to fund. So, that's a dollar that's now in competition for course maintenance, or in competition for G&A, because if you haven't made an assessment or some other way to pay for that, obviously, your dollars are quote unquote fixed. So, thinking about how we're paying for our debt, both in terms of the interest, the debt service, and the principal, and it's pretty typical for assessments to be made, relative to paying back the principal of the debt. Again, if you're relying on your normal capital income, initiation fees and capital dues, to pay down the debt service, be very, very careful that you haven't killed the ability to fund your maintenance capital items in the club. And we've talked about capital a couple sessions ago. That's all about net available capital ratios and things like that. But just be wary that, if it's coming from here, it's new. It's essentially new money. If it's coming from your capital income, now that's in competition for the things that your capital income normally has to fund. So you don't want to get yourself into a capital maintenance snowball effect there. So measure and understand the relative levels. Frankly, higher debt requires higher membership buy-in. So as you're thinking about moving up that ratio curve, the way I think about it is the more leverage the club, the more your membership really needs to be behind taking on that leverage, right? You got to move up. We got 60% approval, 70% approval, 90% approval. The more aggressive you are, I think the more buy-in you need. Those indicators by themselves aren't necessarily good or bad. Everything we do is, as in the executive dashboard or everything, isn't to tell the club, this is good or this is bad, but it's just to give a different and important perspective. In this case, the exposure to debt. I want to finish up because, as always, I'll be about 45 minutes. I never seem to fail. I guess I don't have a problem filling up time. So if you are a CB member, in summary, right now we've finished up the debt piece. In summary, if you are a CB member, clearly, if you haven't gone in and run your executive dashboard reports, you should really do that, and we can help you understand those if you haven't done that. That dashboard is not intended to give you the right answer. Right? We're not in business to say you should do this, you're wrong, you're right, this is too much, this is too little. It's to basically educate and inform you and the board or the controller, whoever I'm talking to at this point. What is the financial model of this club? What is the financial model of the industry? Are we in a sustainable place? And how do the dots get connected between the different pieces so that we're not just shotgunning change, but we're doing things with a rationale, right? So we understand what it means if the gross margin's low, if the dues ratio is low, if our labor ratio is high, what the F&B subsidy as a percentage of gross profit. We understand all that piece, and we understand, are we in a sustainable place? And it's all about the notion of, as I said up front, right? Let's change the dialogue. Let's try to do what we can, right? We have the governance model we have. We can't change that, but we can change the way we work within it, right? And I truly, truly believe that using things like these predictive measures and critical measures begin to put process over politics. We're never going to get politics out of clubs, that's for sure. But if we can chip away at it, and so that when you get board transitions, it's less traumatic to the staff, to the management, it's less traumatic to the club because it's not being whipsawed, because there's continuity of, no, here's how we measure sustainability in the club world. This is what we look at, right? We don't look at what you look at in the inventory or distribution world. We don't look at what you look at in the software development world. This is what we look at. Really important. And I left it sort of as a dot here, but I truly believe that part of this is also helpful to the challenges that exist for general managers and the politics they face. And frankly, we've all been in this industry a long time. We know that a lot of transition in the industry happens as a result of politics, not performance. So anything we can do to help mitigate mute the politics and bring in fact and process is tremendously valuable. Don't need to go through that anymore. So, this is about bringing in real professional business view into the club world for controllers, for GMs, and for staff, and for the board. It's not to be afraid of this stuff. It's to shine light, because every club wants to have a financial sustainable model. Every board at its core wants to do the right thing. Every GM at their core wants to do the right thing for the club, and this just shines light on what those right measures and right things are. Or doesn't make it easy, but at least it gives you some tools to make that happen. So we've sort of talked about this, moving towards predictive management, but it's all about the use of these kinds of executive dashboard KPIs. I would say are now considered best practice in the industry. Bringing them to the next level and actually understanding your own club and bringing them into the board, in a disciplined, metered manner, right? You can't just throw this stuff at them and say, here you go, right? There's an education process. That's what I say. I use the term that takes you to best performance, right? So use of best practice yields best performance. And that's the way I think about what we're doing here with the executive dashboard and everything that sits below it. And that's why we do these as not just for members. We do these for anyone in the industry that wants to listen, because this is important stuff. We've talked about already running your reports. Obviously, it's on the reports tab if you're a member. Here's a little bit of a pitch. If you're a member and your fiscal year has ended and you haven't gotten your trial balance to us, you've seen emails from us, so go ahead and get that data into us so we can get the data in the system uploaded for you, and then you can start running these things. My pitch to all clubs, even if you're not subscribers, most people are probably, are CMA members, and they know that we work with CMA closely with their survey, and we write their report for them. Everybody's data helps. We're making it easier than ever. We'll take your trial balance to upload your financials. You don't have to go in and enter your own financial data anymore. If you go onto the CMA survey tab on the clubbenchmarking.com website, you'll see there's a place for you to upload those trial balance files. So do your part, and this is all important stuff, and it helps everybody in the industry. Even if you only end up getting the CMA report, the more data that comes in, the more valuable all this is for everybody. This is the mission we're making, and it really takes some effort from everybody. I appreciate that. I appreciate everybody's time. I am saying I don't usually do this, but we've had a number of folks call us lately and say, hey, we'd like to join, but I don't have the money yet until my next fiscal year starts in January, February. So if you're in that mode and you want to join, but you're waiting for your budget, you can go on and subscribe and sign up. We have a little coupon code called First Month Free. If you use that, basically what it does is we're going to get you going right now, but it defers your billing and gives you a first month free. It defers your billing into next fiscal, or into January, I should say. So if you're on the fence and you're just waiting for that time, you can go ahead and do that and get things rolling. But with that, we'll see if there are any other questions. I thought I saw Jim pile in. Maybe we can end up tapping into him for that one question Dave Stuckey had. But Terry, do you want to reflect if there are any questions we want to cover? She seems to be muted.
Oh,
Okay.
I'm here, sorry.
Oh, there you go. Okay.
Ian Church asked earlier, it might be the same question Dave asked, does the total debt number include club bonds to existing members?
Yeah, that is fundamentally the same question. We were able to get a hold of Jim by any chance to see how we did that?
I'm on the line. Yep. I'm on the line, and we do not include that in the total debt.
Okay. So those debt to equity ratios, or rather debt to revenue and debt per FME, does not include refund of initiation fee or equity liabilities back to members, right? That's it.
Right. We net the refunds against new memberships.
Right.
In the initiation revenue line or initiation income line, and it's not considered part of debt.
Right. Gotcha. Okay. Great. Thank you, Jim. That was very helpful. As I started answering the question, I realized I didn't really know the answer, and I better fess up on that one. So.
Yeah.
Right.
Terry,
The only other question, which I typed a response to, but it might be interesting to have Jim address it. Someone asked about a line of credit. So if they're running on line for 6 months of the year, how does that weigh into the debt calculation? And I'll let Jim answer.
Yeah, so this is how we show debt. We only show the outstanding debt at year end. So if you have a line of credit that you use for a few months, but it's paid off at the year end, then there's no balance reflected in the debt total that we input into the platform. On the other hand, if you draw your line of credit at the end of the year because you need to bill your dues at the beginning of the fiscal year, then whatever is outstanding at the time of the end of your fiscal year is included in the debt.
Okay, great, makes sense. Okay, well it's 2:45. I've consumed my 45 minutes as usual. If there's anything else, we'll try to cover it offline. But I appreciate everybody joining us today. Again, check out the archives for the other webinars, and we hopefully will see you soon in an upcoming webinar. Thank you very much.